Asset allocation refers to how assets are spread across different asset classes. Key asset classes include equities, bonds, real estate, commodities, alternative investments, and cash. Many investors believe that generating attractive returns is achieved primarily through stock picking, or in other words, selecting the right equities. Others are convinced that investing successfully depends on market timing, so on buying and selling at the best time. But numerous studies show that the right asset allocation is much more important if you want to invest successfully. Why? Because of diversification. Simply put, you shouldn't put all your eggs in one basket. Modern portfolio theory takes this idea a step further. It shows that without sacrificing returns, risk can be reduced by systematically combining different investments. The principle is quite simple. Here is an example of two investments. The petrol blue-colored line shows the price development of investment A. The light petrol blue-colored line shows the price development of investment B. The two investments are developing in exactly opposite directions. If you create a portfolio out of these two investments, the price fluctuations will balance each other out. The golden line represents the combined portfolio. In reality, investments don't develop in such perfectly opposite directions, but the example is a way of clearly showing the benefits of diversification. So, how can investors define the optimal asset allocation or the optimal mix for their portfolio? To do this, we first have to take a look at the risk-reward ratio of various asset classes. Experienced investors know that higher returns also mean higher risks. Better long-term returns can be expected for equity investments than for bonds. But equities entail more risk. One would intuitively assume that a diversified portfolio of equities and bonds has a risk-reward ratio that is on the line between A and B, depending on the weighting. Fortunately, this is not true. Modern portfolio theory shows that diversification can improve the risk-reward ratio and result in a portfolio that follows the curved line, the efficient frontier. For example, Portfolio 2 has the same level of risk as a bond-only portfolio, but has a significantly higher return. And the more additional asset classes you include in the portfolio, for example real estate, commodities, or alternative investments, the better the risk-reward ratio. So, how do you find the portfolio that is best suited to you? Your individual risk profile, your ability and willingness to take risks when investing, is key here. The greater your ability and willingness to take risks, the more you can invest in higher-yielding, riskier asset classes. So you're moving upwards and to the right along the efficient frontier curve. For example, an older investor who's close to retirement age and depends on their current investment income will tend to have a low-risk profile and will build their portfolio using mainly low-risk asset classes, such as bonds and cash. But a young, high-income investor with a long investment horizon can take on more risk and expect to achieve higher returns. This investor is more likely to invest in equities and alternative investments, which generate higher returns but are riskier. Would you like to get more out of your portfolio? Then talk to your relationship manager at LGT about your risk profile and the asset allocation that is best suited to you. But also talk to them about how to ensure monitoring and continuously adjusting your portfolio to market developments.